everyone. Really excited to have a certain guest with us today that I think probably some of you may know or certainly know of them, but may not have had a chance to interact with directly as of yet. Somebody that's become a good personal friend here over the last year. And I want to introduce everyone to Mr. Harrison George. Harrison, you with us?
Yes, sir. I'm right here. Thanks for having me on, man.
Fantastic. I appreciate it very, very much. I think first, if you'd like, maybe you could just give a little bit of basics about yourself, where you live, married, kids, all the good stuff.
Yeah, exactly. Yeah. So obviously Harrison George is my name. I was not named after the Beatles, although my middle name is Paul. There's plenty of people out there that just decide to call me Ringo. So if you're one of those people, feel free to give me a nickname as Ringo or whatever. I currently live in Idaho from California. I've been in Idaho since January of 2018. Currently I'm married, no kids. Hopefully one day we'll have some. I obviously work at a mortgage company. The mortgage company offers, bountiful products, one of the, more unique products, which we will get into here in a little bit, called the All-in-One. Obviously kind of pioneered that as a company back in the early 2000s. I'm personally licensed as an individual in 48 states. I would say that, I'm not the expert in everything, but I feel like I know a decent amount of stuff about the lending industry, although I'm always interested in learning and figuring out how to pair the products that we have with the necessary people to help individuals go from step A to step B in their life, hopefully, and shorten that from 5 years to 3 or 2 or what have you, just to help people achieve their goals at a faster rate.
Like that. Yeah, I think that's great. In fact, as some of the folks that follow us know, or those that I've had direct, interaction with, been in the mortgage business for a long time, about 25 years now, and have been familiar with CMG since shortly after the inception of me getting involved in the industry. I think that you guys launched sometime in the early 90s, and I got licensed in 96, and actually met the executive team many years ago. And I've always thought it's really unique for those of you that might not be aware, and I'll let Harrison talk a little bit more about this, but the very genesis of the first position HELOC strategy, or velocity banking, which is so commonly adopted now, started a long time ago, I guess roughly 30 years ago or so, right here.
Yeah.
The UK with Richard Branson, the Royal Bank of Scotland. Macquarie did it in Australia. And then really CMG became the market maker in the United States. I mean, they saw that opportunity and, what was the perils of, traditional fully amortized loans. Doesn't mean there's not a place for it.
Correct.
I'm going to make that all-encompassing statement. But for those that really understand the uniqueness of leveraging their money and their cash flow, first position HELOCs and the velocity banking strategy is incredible. And Harrison, maybe you could take just a minute and talk about that. I mean, you've been in business quite a while now.
Yeah.
You've got lots of clients across the board. Maybe you could talk about what makes that unique and why you're so excited about that strategy.
Exactly. Yeah. I mean, so there's all these different concepts of like move up blanks in your life. You go from riding a bike to driving a car. You go from buying your first home to buying a slightly larger home. You go from being single to being in a relationship to being married. There's not that many move up products in the lending world. Now, yes, you can go from a conforming loan product into a jumbo loan product. And yes, you're moving up in terms of home value and so on. But still, the premise of a jumbo loan product and a conforming loan product, or really any mortgage product, is based off this wildly attractive to banks calculation that upfront interest with very little principal. And statistically, there's people that live in homes for 7 years where you don't really make much of a dent in your principal balance in 7 years. Yes, you still do, but not as much as perhaps other solutions. I think that this all-in-one loan, this first lien HELOC, is essentially that move up product that people have experienced in their life, of something that they physically can feel on a daily, monthly, yearly basis. Now, again, the first position HELOC in a 30-year mortgage, there's a time and place for a 30-year mortgage. You're just getting into, learning about what we're going to be talking about to perhaps that next step. Well, you're buying your first home. You're not putting $100,000 down. They have products for first-time home buyers. But if you are diligent and understand the market that you're buying in and kind of putting in some elbow grease, you can build that equity, have a little more money, and use that for the next home. It's maybe not the second home you buy. It could not be the third home. It just depends on your scenario. However, this first lien HELOC again started in overseas, Europe and Australia, brought here in the early 2000s underneath a different name called Homeownership Accelerator, changed to something called the All-in-One. Essentially is that move up product, just kind of allows for us to change the calculation that's done on your home that maybe doesn't benefit banks as much. Now, there are benefits for banks, don't get me wrong, but it's just done in a different way that
I say banks aren't completely a philanthropic endeavor.
Exactly. They're in business to make money, and to a degree, I think we've seen what happens when they don't make money. I think the whole world shuts down because of that, or if there's issues with what they're lending, there's problems with that. But realistically, when going through this product, it's really just saying, hey, here's a way that you can pay your home off faster, spend less in interest. You still have access to your money, but if you take the right steps and understand that it's not about buying the new shiny object right now and hunkering down and realizing that you still have 30, 40 some odd years left of making payments on things. You may need to get a new car. Emergencies come up, birds fly into windows and break them. Unexpected. Exactly. Life won't stop life, and I love it. So, and this product is essentially designed for that. You lose your job in a 30-year mortgage, you need to move fast because you don't get a chance to push off that next payment without damaging something, your credit or so on. This product, again, allows for some flexibility in terms of, hey, I unfortunately was let go. We're seeing a lot of that happen right now in just the economy. And this product, if there's the right steps taken place, allows for people to not need to worry and stress out more than they need to about understanding where that next bill is going to be made from.
I think one of the reasons that we connected, besides the fact that I genuinely think you're an incredible guy, and people that are, I think, down to earth and authentic really resonate with me. I think the older I get, the more that truly matters to me. But I also think that ideologically, we have a very similar outlook. What we do with the Money Max account is designed as well to help better allow people to strategically and effectively manage and direct their money. And, we talk about this a lot. I was talking to a mortgage guy earlier today, and, he was one of the few mortgage guys I knew that knew what the actual mortgage came from, the origin of that word, death grip or death pledge, Most people do end up having a mortgage their whole life, unfortunately. And, some of that is just circumstances, but people don't generally live in their same home their whole life anymore. There's a joke, like you referenced, about the 7-year itch, right? The average person biologically, physiologically goes through a shift. And that's why they tend to move in 7 years or get divorced or, various things like that. And I think that, as a financial planner many years ago, strategies sound great on paper, theories, ideas, all this stuff is wonderful. But execution and follow through results is where the rubber meets the road. But that's where most of us really fail, right? Without guidance. It's you and I were talking about setting an appointment, but because we didn't put it on the reminder of the calendar, we almost forgot. Right?
Yeah.
We become so dependent upon technology. And I think that what I really appreciate about the first position HELOC strategy, this velocity banking methodology, but specifically as it relates to CMG, is I think they've got a very unique way that they represent it. Not just the fact that they're available throughout the country and soon to be in all 50 states. And that's almost unheard of in our industry. But maybe you could take just a minute, won't get too much into the weeds because it'd be more appropriate when you're able to deal with folks directly. But what do you think makes your particular product through CMG in this first position HELOC world so unique compared to a lot of the other companies that offer it in the States?
Yeah, so to clarify, the loan's available in all 50. Just personally, I'm not licensed in all 50. Right. However, to say what sets us apart, you're always going to start with, and at least I'm always going to start with, I've been dealing with this in my own personal life, is like just customer service. Somebody actually responding, whether it's after hours or on a weekend, or, hey, I know you have this, you see all of my financial life, does this make sense? Yes or no? No, it doesn't because of X, Y, and Z, or yes, it does if you do A, B, and C. So there's a lot of malleability associated with just the education we provide. Now, on top of that, because this product's been around for so long, and because we have built such amazing systems behind the scenes, that the banking institutions we partner with are very reputable. They're known nationally, so by no means is this some kind of one-off bank located in one area that is able to operate in just a few states. There's nothing wrong with those, by the way. It's just another model for those individuals. More customizable options with this, you have margin options. As you know, the interest rate on the all-in-one is an index plus a margin. So that index is the thing that moves with the market, and the margin is the thing you choose that we add to the index that is determining your total interest rate. You can choose a high margin for less of a cost or a lower margin for a higher cost. That gives individuals some flexibility and qualifications. Obviously, you can use really unique income calculation by assets called asset depletion. So if individuals don't have a lot of money in income, but they have a large investment account, we can use the investment account as on paper income. And again, because we created the product and we created the guidelines around the product, there have been instances where individuals, perhaps based off of their tax returns, may not qualify because of what they've reported, but we can see that the individual is the right individual for this product. Heavy deposits, perhaps, there's an instance where we had a guy that only received one paycheck a year, and that was a fairly large paycheck, but because he hadn't gotten any paychecks for the remaining portion of the year, it looks like, and other lenders would say, well, you haven't gotten paid other than this large one, I think we're running into a problem. Let's dive deeper. Let's ask the why, because there's so many questions you can ask. In my opinion, well, why are you doing it this way? Well, that's because my financial advisor or the business that I own or the business that I work for says that this is the reason why I need to do it. Okay, great. Let's submit that. Let's understand the actual individual instead of just looking at a number on a paper and associating a person with a number. There's real people on the other side of the screen. There's real people on the other side of the phone. And for the most part, those people want to try and take that next step in life, that move up step in their life. And without the proper guidance, like you indicated, being a previous financial advisor, financial planner, you're not going to say, hey, I got a great idea. Let's take your money and earn nothing on it, but it's not going to go anywhere. That's the right solution for some people, for some of their funds. But when people look at their generational wealth, we're trying to build an overall picture of saying, hey, you're not going to perhaps need another loan in your life. That doesn't mean I'm never going to talk to you again. That just means that we're going to help you start becoming less reliant on the bank and more reliant on what technology is out there and what solutions are out there to help build your future and your kids' future and your grandkids' future.
I really like that. And I think, it kind of delves more into the strategy that I always believe that is more of using mortgages as a tool instead of letting it use you. I know that sounds cliche.
Totally.
All the years I was a planner and advisor, as we referenced, one of the challenges that happens is, and forgive me for this expression, but I steal it from my dad, but, the road to hell is paved with good intentions.
Yeah.
We all plan on doing X, Y, and Z. But then this thing called life happens, whether somebody loses their job or they have a kid that they weren't expecting to come around, which is most kids, or whatever the case may be, And I think that the flexibility that more advanced strategies allow is a little bit better fit for the average person's life, right? Now there's extenuating circumstances, but, I joke about this a lot, but, you fix the washer and the dryer breaks, you fix the transmission and the carburetor is, well, the
you get a flat tire, yeah.
Transmission, the brakes go out, whatever. It's always something, and I think the whole life doesn't stop lifing is the most accurate way to say it. So I think having things that can have the flexibility to allow you to be able to adapt to these ebbs and flows is really, really important. And so we'll probably do another video, I think, where you can actually get into real granular details of it, because I think that there's a lot of people that need to know that I think velocity banking is a phenomenal strategy. And we'll transition a little here, because one of the things we know is the common denominator, Harrison, is that most everyone, just about everyone at some level, to a greater or less extent, struggles with how to be able to effectively and efficiently and consistently manage their money.
Yeah.
In an ideal world where everybody had the exact same amount of money and their debts stayed exactly the same, I guess it wouldn't be so tricky. But as I've said in most of the videos that I've talked about, there's a reason that January 1st, there's the same two top year's resolutions there's been for as long as I've been alive, fitness and finance, right? They're easy on paper, but in the real world, they're not so simple because they're constantly moving elements, whether it's the food you eat, the calories you burn, the income you make, the expenses you have. And that's really why we developed the Money Max account as well. So it takes a lot of what you guys are talking about in relative to how to reduce your effective interest rate. Like a lot of people think of interest as being static, like a two-dimensional equation.
Yeah.
Right? There's simple interest, there's compound interest, but more specifically, there's fully amortized interest. And I don't think most people truly understand the front end loading impact and the interest volume effect of having fully amortized loans. That doesn't make them bad in all scenarios, but it means a lot of what you're doing with your strategy is to help reduce that overall net effective amount of interest you're paying. And we're doing that as well. And the system is able to do it with the Money Max account with every debt they have.
Yep.
Whether it's a mortgage or a car loan or a student loan or a personal loan or a credit card. If we own a car, we're probably going to need another one at some point, right? Or things happen. So I think that's why. And I think that's probably one of the reasons that you and I hit it off so quickly. And so from your standpoint, as somebody that's really a veteran in the industry, you've had tons of clients, you understand this space really, really well, the concept we're talking about. What are the things that sort of stand out to you as a mortgage professional and more of a mortgage planner, I would say, honestly, to a lot of the guys I know, and understanding what the nature of what our program is able to do and why that's such a beneficial thing to the consumer?
Yeah, I mean, so I think that the Venn diagram between what you guys have and what we have is, there's not always bad times of life and there's not always good times of life. There's this oscillation. So in many instances in a 30-year mortgage, you hit the good time of life and there's not much else you can do other than building up your savings account. And in many people's instance, they build up a savings account, they go out and spend that money because now they have this savings account. The continual upward trend of that good time of life in the first position HELOC allows for you to take advantage of the good times so that in the bad times, you're able to mitigate a lot of the hurdles and stress that a lot of people will experience. I mean, you have several good years, you pay the mortgage down faster, you get this big line of credit. Well, unfortunately, you have surgery, a major medical emergency, you have a job loss, something happens in your life and that income declines. Well, you're only as good as how much you've saved up. And if you thought things were going to last be great forever, you spent a lot of that, now you've encumbered yourself with too much additional debt. Where this product says, hey, you got this big buffer and you're able to take care of this buffer while you figure out your next step. And I think the benefit of the Venn diagram of what we have is you're saying, hey, here's your debt and here's how you can make that zero as fast as possible without negatively impacting your life, so that during the good times you can take care of it, so that during the bad times you're mitigating that hurdle of crippling debt.
That's it. You're hard. I like it. That was a good explanation. That's really good. Yeah. And that really is true. Listen, we say, I think you've heard me say it probably a bunch of times too, Harrison, that, we call it financial GPS for a reason, right? I'm ashamed to say that no matter where I go anymore, it wouldn't matter if you and I were neighbors that lived across town from each other. I'd probably still click Harrison's house on my GPS just so I don't have to think about it, right?
Yeah.
And I wanted to just do the calculations for me, but also, because even if I know how to get there, I don't know if there's going to be road construction ahead, or a detour, or a car accident, or a railroad crossing, or whatever. And I love that it can instantaneously make those recalculations. So I think that's really what's cool. And I think there's a great synergy and a great marriage between the strategies, because even among those that are utilizing this velocity banking strategy, using your all-in-one account, I think can be enhanced considerably, because when you actually have a monitoring system that's helping you understand the impact of the dollars you just deposited or the purchase you just made and how that impacts your debt-free date, if you will. I had a conversation last week, I guess it was, and one of the things that really came out of that little dialogue was that when you're looking at, the tech guys in our company, of course, they're these really brainiac guys, and they'll tell you about all the factorial math engines and the code and all that. And it's great. It's cool. I mean, hey, they're smarter than you when it comes to that. But where the rubber meets the road is the dashboard. And that's really, I think, where that ability for that integration to come about, because just like with GPS, it's not so much the triangulation of this technology on your phone with a satellite. I mean, none of us can even explain how all that works exactly. However, it's my ETA, how many more miles I have left, and how many more minutes. Because then if I have to miss my turn in 200 feet, it's going to recalculate and say, well, guess what, Harrison? Now you got 2.1 minutes, but 2.1 miles, you had 3.6 minutes. And if you're running a few minutes behind, what do? We put our foot on the gas, we drive a little faster. We kind of go through that orange light. We don't come to a full stop, we make a turn. Imagine that financially. So now talk about just adding an extra layer of direction and navigational support in terms of helping families understand the impact of, hey, my daughter's wedding is going to be in 3 years. We need a new car next year. We got to get a new roof. in real time, understanding the long-term impact of that decision now is really massive. I don't know what your thoughts are.
I agree. I think the fact that the analogy of your guys' program is the GPS. I think that equivalently, the all-in-one is the vehicle that you put the GPS in. You could be driving a Datsun, or you could be driving, a Tesla or a newer car. And it just depends on the vehicle you're in at the end of the day. A 30-year mortgage still is going to get you to the location. Now, is it the most efficient way of getting there for your family? It may be. There's nothing wrong with that. However, for the certain individuals that can change vehicles, products are allowing for them to expedite that payoff, get to their location faster.
Man, that's really good. In fact, it's almost like we did this before. We've not. One of the things that you say about GPS is that what people don't think about is that it gives you a defaulted preference, right? But you can customize it to shortest route, fastest route, avoid toll roads, highways, right? You can customize it. It just defaults to a setting. But the GPS, like you said, it doesn't care about the destination. You choose it. Right? Obviously, in this case, it's to get that free as quickly as we can, but also to save as much interest in the process, right?
Correct.
But it doesn't care who's driving, and it doesn't care what vehicle you're in.
No.
It's ubiquitous, right? It has no emotion. It has one goal. How do we, at any given moment, tell you the best and highest use of the dollar? So I love that. You're right. It's all about the vehicle. I tell this to financial planners all the time, too. We're not dictating what that strategy should be. We're simply using our particular tool, our GPS. Again, whether you're driving, I'm driving, your wife is driving, whether it's a pickup truck, a bicycle, or a school bus, GPS doesn't care.
Yeah.
And I think that's what makes it such a great fit, within the industry. And as we begin to focus more of our energy on dedicating real financial professional partners, our goal isn't to direct clients in a given path. It's to help them do what you want them to do, to help you do more of it and to do it more effectively and efficiently. And that's why I think it's such a great marriage. And, we're really, really excited about the opportunity to collaborate with you guys.
Likewise.
And we're national as well in all 50 states, as you know. So that's almost like a marriage made in heaven there. But
exactly.
Mortgages are a very important vehicle. That's why I got in the mortgage business. As a financial planner, I just wanted to help them make sure they were saving enough money for college and retirement and they were adequately insured. Problem is, the number one reason most of them couldn't do it, they didn't have the money.
Yep.
So I thought, well, if I could get a mortgage license and I could restructure this biggest debt and I could direct those dollars or redirect them before they spent them, it would be successful.
Correct.
The weak link was we didn't have a virtual financial coach. So I'm really excited about, this collaborative relationship, this potential partnership with us, because, I love the way that you can dedicate a lot of energy. You're very hands-on with the people you work with and your clients. You just don't find that a lot anymore. It's very transactional business. I just really think that's disappointing. It's gotten to that place. So you can find other like-minded people like yourself that are very client-centric, that are very educationally orientated, and are really becoming a trusted advisor. I mean, those are the perfect partners for us because we work hand in glove, with those very strategies. So, I mean, we're so excited about that opportunity, Harrison.
Thank you. I appreciate you giving me the opportunity to chat with you.
Yeah, absolutely. We'll do it again. We'll definitely get together soon, and we'll allow you to provide, obviously your information on the link and so forth here. Obviously Harrison is somebody to work very closely with. We highly endorse not only CMG, but Harrison in particular, and we look to hopefully cultivate and build this relationship on even a bigger scale over the next year or so. Yeah. And it's really a privilege. We thank you for taking the time today, and we're looking forward to many more opportunities in the future.
Likewise. Thank you so much.
Thanks, Harrison.
Bye.